So good morning and a warm welcome to ILA Roundtable on Startup Ecosystem. The event has been brought together for us by ILA Mumbai chapter. Before we start, myself Madhura, I'll give you a brief introduction about ILA as well as will introduce you to our speakers today. So Indian Lawyers Association is an organization working across India to bring all the legal professionals under a roof. We have a couple of initiatives by way which we do this. We work towards improving our profession and serving our members by way of organizing programs and services which promote members' professional growth. We have a lot of development opportunities for law students and lawyers across the country. We run a few initiatives for mentoring and support for our regional chapter. And we, of course, offer a platform for networking to our members as well as all the legal professionals. We work to increase the public understanding of and respect for the rule of law. And the ultimate goal of ILA is to create a united voice of the country's legal professionals. We have several initiatives, and one of them, a promising one, which has been recently built by our ILA members, is a pro bono activity, a legal aid initiative, which actually took off very well during the COVID times, thanks to our ILA Delhi chapter. So we have about 75 chapters in the country. We welcome all our members, all the participants who have joined here today to join a chapter in their respective cities. And if you don't see a chapter in your city, please feel free to reach out to us and we would be very happy to start a chapter in your city as well. So before we start, allow me to please briefly introduce our speakers today. We have Mr. Ashwini Singh. Ashwini Kumar Singh is a managing partner of 35 North Ventures, Asia-focused VCP firm focused on technology and B2C companies. He is a Sloan Fellow from the London Business School, MBA, and a Bachelor of Technology, certified investment professional from the Institute of Professionals, UK. He's a seasoned professional with over 24 years of experience in investment management with global financial services firm in India and Europe. He has managed investment and advisory asset portfolios of over 3 billion USD and has unique and extensive experience as an investment manager. Mr. Singh is also the CEO and CIO of AgriCrest Investment Advisors, an agri-focused impact fund that enables to build agri and farming ecosystem. We welcome you, sir. We have Ms. Pooja Terwad, who is the founder of the Startup Gig, a law and a startup consultancy firm based in Mumbai. She chose startups as her niche after working with several startups in the Silicon Valley, USA. With an objective to create an end-to-end startup consultancy and servicing firm, she started the Startup Gig in 2015. In the last 6.5 years, she has been a part of over 600 startup deals. She works with investors in India, USA, Singapore, and Japan and assists them in their funding exercises as well. Pooja holds a dual LLM and is a gold medalist from Jindal Global University and Indiana University, USA. She is also a visiting faculty at NMIMS, Mumbai. Welcome, Pooja.
Thank you, Madhura.
We have Darshan Surana, who is co-founder of ZN and Associates, Chartered Accountants. Previously, he has been with Gen Irrigation Systems Limited as a vice president handling corporate finance, mergers and acquisitions, and investor relations. He has reasonable experience in handling transactions involving structuring, due diligence, valuations, deal advisory, and so on. He has also worked on corporate restructuring, mergers, demergers, mandates, including inbound and outbound strategies. He likes to work closely with founders, startups, SMEs in their inorganic endeavors in India and across the globe. During his work experience, he had an opportunity to work with companies in Brazil, Mauritius, UK, and USA. He has worked with several angel networks, VCs, investment bankers, lawyers on various transactional matters. We are pleased to have you, Mr. Darshan, with us today. And our moderator of the day, Darshan Upadhyay. Darshan is managing partner at Strategy Law Partners, Advocates and Solicitors. Previously, he was a partner at Economic Laws Practice and advised several Fortune 500 companies in India entry, M&A, corporate governance, joint ventures, regulatory issues, and due diligence. He has expertise into fund formation, assists on private equity investments, shareholder disputes, and insolvency-related matters. I hand it over to Darshan to kindly take it forward. Thank you.
Oh, thank you, Madhura. And a very warm welcome to all my panelists and everyone who's participating on this webinar. To set a context, let me just give you some anecdotes. There was a report a couple of weeks back, and India was mentioned as the third largest country in the ecosystem, followed by US and China on the startups and unicorns. A recent publication on Financial Express mentions that there was almost the last year, and you will find that with many of our advisors advising this, that the last year has been very busy for all of them. We saw almost an investment of around $35.5 billion in India. Now, what is all this about? We will see that you will see governments coming up with a lot of initiatives like Startup India, Make in India, which has been given a push for the last few years. We recently saw there is a big push for semiconductor industries and EVs and other alternate avenues for clean energy. We are seeing a lot of reforms in these areas, not only under laws, but also policy level issues in this. I don't know about everyone, but it's now we all have faced that it's very difficult to keep your kids away from mobiles. And that I think affects all of us in terms of how the last 1.5 years have seen challenges, technology advancements, work from home, which was just a thought a few years back has now become a reality. Whichever field you are, okay, whether you are a corporate advisor or whether you aspire to be a lawyer or a service provider, assisting any of the corporates in India, I don't think this is a sector that can be ignored. Not only in terms of the opportunities and the professional advice, but also to see how we can gel together, how we can see how the market is moving and whether we are aligned to ourselves to that. All of this, of course, creates its own set of challenges and also an opportunities. We have a very esteemed panel today. Idea is to see whether what is going on is enough, what is lagging, how we as professionals can make a change in this industry, what we should all come together and see how we see the next year coming once we end this 21. So let's start the session by Ashwini, if you can start by giving your inputs on how you have seen the last 1 year, what you see what's the trend, how it affects all the professionals. Love to hear from you.
Sure. Thanks, Ashin. In fact, I would say the last 1 year, we have all learned new business models. Industries have learned how to adapt to supply chain changes. We have all learned different ways of how we live our lives and also how professions are done. Banks today open accounts without seeing you, through eKYC and certain other places. You do transactions with people over a Zoom and otherwise. You try and create modules by which you try and gain trust, which was earlier done only by face-to-face meetings. And compliance is a lot of the stuff which you required teams to meet together, come to know, do executions, business plans, in face-to-face. All of us have learned to adapt. All of us have learned to adapt in terms of how to use bandwidth effectively at home, because that's where most of us sort of moved our offices. Every room sort of became an office, whether it was for yourself or a working spouse or for kids per se. So the school also in a way transformed into the house. And we all learn to live with the challenges. So whether it is for a company starting up during this phase or trying to raise capital, work out with their bankers, work with their suppliers, work with their customers. These were things which were never heard of before. And we all realize that do we actually require such big offices? Which has impact on two things. One is, all of us who live in Bombay can understand the pain of commuting to office if you're not lucky to have your office and home close by. And you suddenly realize that, fine, you could save those couple of hours at least, or if not 3 hours in terms of commute more effectively. And I would say with that, it brought another challenges. Your lunch timings were no longer fixed because you could have calls any time. You could be available and there's no fixed start or end of the time because all of you are available at home. So you're not stuck in traffic, you're not reaching back, and so those were all things which we have grappled, and it has led to the way we lead life change. So shopping has become a lot of it online. Your return of goods, looking at quality. So earlier, you would say that if I've not heard of a brand, if I want to shop on it, till I go and see it in a physical location, that's when I will say that, okay, the shoe is good. Or we all have perhaps learned to shop in terms of knowing that, okay, a US or a UK or this is the fit which comes in. Okay, what's a large, what's an XL, in different brands which fits you. So all of these things you would physically try it out. So I would say, even if you look at from industries, globally used to have in the clothing sector about $16 billion of returns which were coming. So overseas, you would have the Black Friday, you would have the pre-Christmas sale, all of it. People, and any one of us who's been abroad during the time, you would have people who will rush and have queues from early morning, if not from late night, who have gone, picked up a bunch of clothes, may buy 2 out of the 20, but 18 goes back at returns. Now, all of that has changed because anyway, that's how you've learned to shop. You've learned to look at also tastes, whether it is sweet meats or a particular cuisine, because restaurants have learned to adapt to the fact that there is more QSR piece happening or takeaways happening than fine dining. And even with fine dining and other places, you've turned to try to see how does it work with limited capacities. Hotels have tried to adapt. So it's a very interesting phase, and I guess the companies which have come out of it alive, I would not say unscathed, have come out stronger and into more durable as well as flexible working models.
No, Ashwini, all the fair points, and I think many of us can relate to that. And I think if I say innovation and change inevitable, which we keep on hearing, I think that's what you are pointing out at. Whilst we are still grappling with all this technology, I don't understand much, but I was hearing a webinar from one of the Facebook's founders just few days back, and they were talking about a new concept called a metaverse. I mean, we have not even grappled this, but then the way they were explaining that eventually everything will move toward a virtual reality where you will not step out of your home. So, I mean, I don't know how this changes all of this, but yeah. Darshan, why don't you give your views for what's your journey been the last 1.5 years? What you see the trends changing?
Sure, thanks, Darshan, and thank you for the opportunity. I hope I'm audible to,
yes.
I'm reasonably audible. So I think, yes, taking from what you said and what Ashwini said, just a couple of points on that. And then, I think, on a lighter note, we also saw like some of the largest IPOs and the due diligence being done on the phone cameras, right? When so I'm not sure, whether that's an area of concern or that's a growth that we've achieved. And I think the other thing that on this whole work from home front, there is a lot of sort of, I would say, growth in the gig economy in the country as well, where the whole freelancing base of the country is going up, whether it's IT, it's finance, it's other services. I think that's a good sign because earlier Pooja was mentioning about the overall service cost, and especially for startups. I think this is going to help to sort of have these services available to all the people at multiple levels of their businesses. And I think the third thing, certainly, I would like to say before we get into the larger discussion is that, the whole rise of Robinhood investors and how that has changed the mood and the momentum in the capital markets, which has, effects on the private markets as well. For example, we not seen so many friends and family rounds, or in fact, like individuals investing into the startups. And now we certainly see, like, even our immediate friends and, our colleagues investing like, 5 lakh, 7 lakh, 10 lakh, participating in the multiple rounds in the startups. And they're coming and sort of showing the term sheets to us and seeking an advice, showing the valuation reports to us and seeking an advice. So I think there's certainly, all of this has certainly a positive impact. I think moving on the transactional front, one of the key features that you see is that the whole the IPOs and the pricing that we have had for the IPOs. I'm not sure whether we can still call them startups, but it's certainly going to help a lot of startups to envisage exit situations, exit multiples in that space. I think on the deal front, we continue to have a large number of deals in sub $5 million category. And that's again a very interesting point, because you need not sort of have a 50, let's say 50 crore, 100 crore kind of a valuation, and sort of, this is the sweet spot for the investors also that we see. I think again on the transactional front, if you see, there is a lot of interest on incentive for the people to come up with the private brands, private label, either whether it's a person working out of small shops, they're getting acquired. Strategic people are looking to sort of add ancillaries. Take a look at, Byju's Whitehead Junior. It's a classic example of how valuations were achieved in the shortest span of time, as well as the exit was achieved. So yeah, I think these are some of the things that I would like to add on the transactional front.
The way Darshan, you and Ashwini are saying, maybe sometimes we feel that are we in a wrong profession? We should be starting a startup and see how the valuations go. But yeah, Pooja, why don't you come with your bit? Pooja, you are on mute.
Yeah, I'm so sorry. I think in continuation to what Darshan and Ashwini mentioned, as entrepreneurs, we're always taught to look at the positive side, and the glass is always half full for us. So I think the first half of 2020 was slightly, actually very scary. I've been so consumed by the ecosystem energy that I at least speak to about 15 to 20 new founders on a daily basis. So my phone's always ringing, and suddenly it went silent for the first 6 months. So I think that was very scary, but I think we were really very resilient. The ecosystem was resilient. It really picked up in the second half of 2020. We saw a lot of new tech startups coming in. AI ML was completely on a boom. A lot of investments happening on that front. We've had almost 12 new unicorns in 2020. So I think that's the good part. But to what Darshan said, I think I would really like to add, although the number of deals went down comparatively, if you look at the statistics in the previous 2019, 2018, however, seed investment drastically rose. So we did see a lot of transactions happening on smaller ticket size, but a lot of small angel investors. So that kept the ball rolling for startups. Startups would have otherwise had no choice but to close down, could survive. And I think 2020, so in 2015 to 2019, if you statistically look, I think more than 500 startups closed down, but 2020 was a year of rebranding. A lot of new startups changed their strategy, changed their business model, and that I think led to a lot of positive sentiment in the ecosystem. I feel investors, and I'm sure Ashwini would agree, investors also tried to diversify. They were of course testing waters before investing, but I think they also diversified, took risks, looked at upcoming sectors. Cryptocurrency saw, blockchain is still seeing the boom. So I think a lot of sectors are now coming up and investors are wanting to invest. But what I would really like to highlight is some of the startups that, if you look at how things have changed at a global level, of course, working remotely, a lot of bigger companies like Google are acknowledging that, it's actually proving effective, not only economically, but also when it comes to maintaining a healthy work-life balance. And it's actually improving if, work output is better. Locational constraint has reduced. I remember while we used to hire, we used to always look at graduates from Delhi, Bangalore, Bombay, because that is where we have our places, we have our offices. But now I have a team which is right up to Northeast, and I think it's amazing. I've never met them, but I'm working with them. So I think that is really wonderful, and that's happening with a lot of startup because location has reduced. Also, startups like GoFundMe although it's not an Indian startup, but started by two stay-at-home moms, and that they've helped people raise thousands of dollars. I mean, that's the social impact which the pandemic has got. I'm sure 2020 was slightly tough for entrepreneurs, but I think they pulled it really well. Investors also were very supportive. So I think, and we're actually seeing the after effect in 2021 also. I think we've broken all records. 2021 has broken all records. So we've seen the dawn.
Yeah, all positives. Yeah, but let me just say, I come from a business background, and at least a decade back, if someone were to ask if you want to start a business, generally your parents, at least on my generation, would say, it's very tough, it's this, it's that. Now we see a kid of 16 years doing a startup. So it's an amazing change. Originally the capital used to be only from banks and your family and friends. Now with so many, and at least what I see from SEBI is we have almost 800 to 1,000 funds who are active, from both angels to the growth stage. And that's what's led this entire change of this ecosystem. So Pooja, you, Darshan, Ashwini all spoke about this promoter, this startups, this new areas being coming up. Now more and more that we work on a transaction, we see that the promoters find it dealing with multiple investors. Earlier, the trend was that you will take one or two investors and go to an IPO. Now we see Series A, Series B, it's gone up to all the alphabets that's possible. And their stakes coming lesser and lesser. Ashwini, how do you find a balance with when you make investments? How do you keep the promoters enticed? How do you see that they are still having the same enthusiasm, and at the end of the day, they will see the light of how they grow their capital? Is there any new instruments you are looking at? Is there a different structure you are looking at? What do you see the opportunities could be there for all the advisors on the call?
So if you look at it, our philosophies remain the same. We look at the quality of the the promoters, and we look at the business model. That's the key thing. So if the quality of promoters, the initial founding team is good, and they have a good business model, then we are always there to help them fine tune it, take it to the next stage, and so the execution capability becomes quite important when you look at an early stage growth company. Okay. One key thing which we always tell promoters and others is that there has to be two things. One, there has to be skin in the game. Secondly, there has to be a point where they are also able to sustain themselves from the company, but also provide an exit to institutional investors such as us, because we have a fiduciary responsibility as a fund, and eventually we are accountable to our fund investors, and we have a particular returns to give. We have a particular responsibility to ensure that the money doesn't go down the drain. So these are the few things which we look at. But we also, when we look at the initial founding teams, there are a lot whom we tell them that please go back to your drawing board and come back, because sometimes what happens is when you're too caught up with an idea, you forget about how the universe looks like. And there could be, your idea maybe actually needs a lot of tweaking, or it may be a little too late because you already have bigger guys in the play, but you are not aware of them. Okay. Or there are sizable other entry barriers or growth barriers which you are not perhaps accounted for. So so it's always a dialogue which we have, and it's a two-way street in terms of seeing how the promoters or the initial founders have looked at these challenges, what are their ideas in terms of surmounting them. And we try and take an active role in each of the companies where we invest. So we are actually not dump money. We look at adding value. So if we can quicken the pace of growth for a company, that's when we feel it is good for us to invest.
And as I was mentioning, Pooja and Darshan, I mean, we have seen, earlier the model was you do an equity. Now we are seeing convertibles, we are seeing notes, we are seeing a combination of that. We are seeing class of shares. I mean, with all these trends, and also the primary question on how promoters then still feel involved when their shareholding is coming down, how do we protect them? Pooja, why don't you, we have many lawyers on the call, so why don't you give your experience?
Absolutely.
Sure. So I feel it's actually a very, very valid question. I think most of the startups you speak with are confused, because if you remember, we just spoke about seed investors coming up, right? So the investment ticket size is 5 lakh, 10 lakh. Now with that small amount, getting into all the compliances, getting a valuation certificate from a SEBI certified valuer, from a merchant banker, the lawyer, the CA, the CS, all of this gets very expensive and it's impractical. So this new methods that have come out basically are the jugards that, you know, startups and lawyers and everybody have actually come up with. These may not be necessarily prescribed by the books. And I feel, as a lawyer and also somebody who, you know, we are expert in interpreting the law, I feel we are actually lagging behind. We really need to catch up with the pace, with the way technology is moving ahead. I think our law somewhere falls short of it. So you're correct. We've already had equity, private placements, we've had venture debt, but they have their own pros and cons. Equity, like I mentioned, private placements will have huge compliances. Venture debts coming from venture capitalists without any collateral gets very difficult. Your convertible notes, if you've heard of iSafe, that's come up by, you know, a lot of VC funds have now started engaging with iSafe notes. These are a hybrid of equity and debt. So basically, you're not doing the compliances at equity you require to do it otherwise in a private placement, and you're also not paying an interest which you're supposed to pay in debt. It's a mix of both, but it's not exactly defined. There are no guidelines in the book per se. So a lot of CNCSs actually say, "Hum to convertible notes ka kaam nahi karenge," because it's not there in the books, and they are not entirely wrong. But then what are the startups supposed to do? For a 5 lakh rupees investment, every time getting a valuation certificate is very difficult. So I think that is one big challenge that, as you know, as industry experts, as compliance experts, we are regularly facing, and also the startups. So convertible notes for small amount is the most chosen method of raising funds, the most chosen equity. It's for a limited span, but there also you have a lot of caveats. You have to structure the funding in such a manner कि आपका अगला फंड का विजन क्या है, when it is going to come. You do not want a tool बहुत ज्यादा time between your convertible notes and your next fundraising. You do not want any question coming from the bank or the RBI or anybody. So ये थोड़ा सा, there are a lot of loopholes there which we need to take. So we are not doing anything that's illegal, but that's not entirely legal too. So I think the law really needs to catch up. That's one big problem that startups are facing as on date.
I think good input, Pooja, but I think many of persons on the call may not be aware of what are these notes and safe note. Darshan, you want to take it more on how you have been looking at it?
Sure. So I think going back to your question, Darshan, first of all, you know, really, if you visualize the cap table of a typical startup, right? So on the day one, you will have a founders team, which is, let's say, having about 80-85% of the cap table. And you have employees, you know, you have a sort of a reserved quota for the employee stock options, KMPs, which could be, you know, 15 to 20% kind of a allocation to them. And then really what happens is that, you know, as and when you start raising funds subject to your valuation and the speed at which you want to close your rounds, the founders keep on sort of getting diluted, you know, their stakes. And very often you will see that post Series A, post Series B, you will be under 50%, because that is a period when you need a large amount of capital, but the valuations may not be bespoke. And the question arises, you know, now how do we sort of, so first question arises, you know, while the new investor is coming in, what kind of instrument to be allotted so that at least you know, on a anti-dilution or let's say post-dilution basis, how the cap table looks like. And then, you know, the notes that Pooja referred to, you know, these are essentially in the nature of compulsorily convertible preference shares. or at times these are compulsorily convertible debentures. These instruments have been used in India a lot for the FDI transactions historically, because from the FEMA regulations perspective, anything that is not compulsorily convertible is treated as debt, and that's not allowed as a investment in a normal FDI sort of a transaction. And but what in a startup situation, what happens is, you are also slightly clueless about the valuation, right? So the safe note that was discussed, I think it essentially says that, we are putting in this money, we have this instrument, and it will convert into equity on achieving certain milestones. All right. These milestones are typically defined either in the form of a next round of investment or a valuation of a next round of investment, or they could be linked to certain performance benchmark by the or certain KPIs that the startup is supposed to achieve. And it can have a cap and a floor. So, the dilution cannot be at a price less than a particular level. And because I'm coming it at an early stage, it can also provide for a discount. So let's say a friends and family round, you'll say that, hey, because you're a family, you're coming on day one, here is the note. And whenever my pricing event happens, which is, let's say, within next 1 year, at whatever price it might happen, I'm going to give you a 20% discount. Okay, so these are very highly customizable instruments per se. There is a little bit of compliance overhang on that, as Pooja mentioned, in terms of valuation, and especially being a valuation profession, it does get very, I would say, difficult to value this instrument, because they are not plain vanilla equity. And you don't even have the conversion to say that it's 1:1, because the conversion event has to happen. So you're actually shooting in the dark. So for us to give those compliance certificate or a valuation certificate to meet the Companies Act requirements or a FEMA requirements, or now to some extent income tax requirements as well, section 56 to 10, etc., it does get a little difficult. So this is, I think, the structuring part of the first, the entry part of the instrument and how you can structure it. And then the second question that comes up is that the founders have certain expectations on retaining their stake, right? Because they are getting diluted and they would want to sort of say, oh, can I avoid it? Or I need still some sort of a more skin in the game. There it gets little, difficult to structure because of the taxation regulations that we have. We have seen certain transactions where people have done some sort of a debentures being issued at a significantly lower value, and having a sort of a fair value after a couple of years, which is linked to the equity, etc. And those, because the founders are also not supposed to put in a cash, because that defeats the purpose. They typically, do these debentures as a pretty, low face value. Then there is a second option that people often evaluate, which is in the form of a sweat or an employee stock option. There we need to be careful about the Companies Act requirement, or even income tax implications, because in Companies Act, unless you qualify as a particular level of startup, you cannot allot ESOPs to, let's say, founders or promoters, or director owning 10% or more shares. Then you look at a sweat equity, etc., etc. So these are the typical situations that we get caught into, and some of the solutions that we look at.
Fair point. So Darshan, what I understand is now we have too much of an option to structure a transaction keeping the commercial intent in mind. The earlier pure equity model has changed to many different instruments. But what I don't understand many times, and we get this question very often, is how do you value this? How are you creating so many unicorns with companies having no asset? Ashwini, have you, and many times while discussing with all the investors, I keep on hearing from many of my clients, it's become a buyer's market. I mean, people ask valuation and we have to meet that, or we lose a transaction. So, I mean, is that a similar thing you are also facing? And how do you guys value these companies? You know that you are investing in X capital, company has no assets, it's only running a service market. It's very surprising. I mean, to name a few, very recently, even Paytm is very surprising why the market crashed. We all know. I mean, people all thought it differently. But what's this secret formula?
So I think it's a question of going back to basics. Okay, and so I'll take two things. One, I'll add on to what Darshan was mentioning, but I'll first answer your question first. So we always felt that if there is an actual demand being created or an actual problem being sorted, that will be tenable in a longer term. Okay, so for example, if you look at what did an Ola do, it created the allowed you to book, have the convenience of haggling with a cab driver, and at a time, at a location which is feasible, right? If you look at some of the ideas which have come, which are actually fulfilling a need, they will stay irrespective of what. Then what comes is the second part. So I may say ITC or an LMT is a great stock, but then at what price I take it is a separate question. So similarly, the first criteria for us to see is that idea great enough? Are the promoters good enough to execute on that great idea? Okay. Then this other piece which comes, are we coming in at an appropriate valuation? And that's where it also goes to what Darshan was mentioning earlier, that you look at a floor and a ceiling because it's an undiscovered part. It's like a pie in the sky in terms of saying that, okay, is it $10? Is it $100? None of us know. So then you look at what are peer multiples, you look at similar cases. And what I sometimes don't find it as different is that one has to define what are you catering for. You can't say that, look, I'm looking at US valuations, but my metrics are Indian. Okay, so either you play from an Indian market perspective valuation, you look at a US market perspective. So you can't be on both sides, like I want my cake and I want to eat it also. So that's one place sometimes when education comes in, and we're happy to let go of deals which do not make sense from a part, because eventually as an institutional fund, I am supposed to deliver to my own investors. So we try and have that clear benchmarking. Coming back to what Surana was mentioning in terms of instruments, and all of these are basically trying to mitigate a problem that you're trying to have a trust being created by virtue of a contract. Okay. Second part is you're trying to protect the investor as well as protect the promoter. In our country, it's only recently, I believe, the special founder shares part has come up, which is still untested, right? Overseas, it's been around for a while. So whether it is the Mercedes family or the others who own the BMW and other Mercedes brand, they may have sub 20% shares, but they still control and operate the company. Okay, so there are different kinds of shares which have been around for in our country. They have just started untested. So only when you are subjected to a legal challenge, you'll come to know how they stand the test of time. The other piece which comes in is that unfortunately in our country, the enforceability of contract law is very poor. And hence what happens is you go into more unconventional or a different ways. You try and get market feedback, you try and ensure like a poison pill that the reputational damage for a entrepreneur who pulls a fast one is more, or even similarly for an investor who takes in a disproportionate portion of the pie, because what in a way all of us were alluding was that you would not have people, for promoters' interest to be valid, they need to see that they are getting sufficient for the pain they are taking to create an idea, take it to execution, scale it up, and distribute wealth, not only for themselves, but also for all the people who have believed in them.
Yeah, I agree. I think we touched upon valuation, which is a subject in itself. I don't think I'll get a right or a wrong answer. It's more of a political answers by everyone. But now let me put it this way: we had a history of tax disputes, and we had a history of how the investors and the community looks at the tax planning and the things how they change, right? Do you think that now we have sufficiently addressed that issue? Angel tax is behind us. We have some other clarity on Mauritius, Singapore. This investments now more or less from a tax perspective and the structuring. Do you think that we have reached a stage where we don't have to worry about all those issues? Pooja, you or Darshan, whoever wants to start that. Darshan?
Sure.
Yeah, Darshan, please.
Sure. Thanks. So Darshan, I think, so see from the startup perspective, okay, if you look at it, so there are two perspectives here, right? One is the investor perspective and the second is the investee, which is the startup. Now from startup perspective, really speaking, it may not matter as much the jurisdiction, because it's really for the tax and the regulatory purposes of the investor, so to speak. There are certain points we always sort of still keep in mind where, until now, let's say, for example, Mauritius was under the gray list of FATF, right? And we would say that, okay, maybe you can stay away and look at Singapore or look at more mature jurisdictions for that matter. So those sort of, optics related perspectives certainly has to be sort of taken care. Again, from the investor standpoint, I think what happens is, now the entire world is moving towards the global taxation. Like you must have heard about the situation a couple of weeks before, where OECD countries have agreed for a minimum corporate tax rate of about 15%. So the entire international tax platform is getting into the substance-based taxation. So for example, let's say you are a financial services firm, you have office in US, Mauritius, India. People can look at, your team composition at each country, how much salaries you are paying, and then look at and who's taking decisions and apportion the profits. This is where eventually it is going to go. So and now with a certain tax changes, of sort of earlier structuring of, making the entire capital gain tax zero or neutral for the investor, you may not have some of those avenues very obviously available unless you are a very, very strategic investor having a good substance from one of these jurisdictions where the tax rate is below India, for that matter. So I think, and people have also now settled in their mind in terms of these tax implications, because they believe with the introduction of GAR and the sort of entire journey that Vodafone also has gone through, the tax changes have gone through, this is pretty acceptable to everybody. From the on the taxation front, from the startup perspective, one thing that we often suggest is that, there are certain avenues available under the Income Tax Act where you can actually make an application to either DIPP or to the Income Tax Department and avail certain tax exemptions from the so-called angel taxation issues. Or, in fact, if you look at Section 80 IAC of the Income Tax Act, and if you sort of get that done, you can actually avail 3 years of a tax holiday for your startup amongst a particular specified period. So those are the sort of avenues that are available to mitigate some of the investment related risks. There is one challenge that often comes from tax perspective, is that, on the Section 79, which is a carry forward losses of the startup, if the ownership changes more than 51%, what do we do? How do we protect it? Because that is one of the assets that is lying into the company, etc. So there you have to basically break a little bit of head around, what are the possibilities of structuring. So I think there are some of these issues from startup perspective are still, I would say, not very, very settled, including some of the valuations and the tax issues linked to the valuation. Because what very often happens is that once the company is after Series A, they keep raising funds every 3 months, 6 months at different valuations. Okay. And let's say, there are domestic investors participating in different rounds at a where the valuation is changing in a shorter period of time. There are questions being raised from tax perspective, whether there is any tax event here for the company or any adverse tax implications for the company. And we have to take a lot of time practical calls and mitigate some of these things and sort of, back it up with fresh set of valuations, etc., etc. So there are some burning issues there, which we need to keep in mind while structuring the transactions. But I would say at least on the investor side, on the overseas jurisdiction side, I think the positions are pretty clear. And people are happy to not pay so much attention to that, and attend to the investment and making returns and have excess returns there.
Yeah, I would agree with you, Darshan, on that. But Ashwini, you raised a very interesting question on, and that's, I think, for many lawyers, it's been a hard topic of debate on enforceability of contracts. What do you mean? I mean, is there a particular section? And I would like Pooja to step in there, but is there a particular clause or a particular event that you were referring to when you mentioned that?
See, when you look at contracts, and whether it is from an equity perspective or a debt perspective, whether it's a convertible or non-convertible part, and I've seen the earlier so-called hybrid structures, the FCCBs, which were around about a decade plus, and I ran a FCCB fund out of London at that. So those were for larger corporates, so you had a lot more clarity on different part. But if you look at it, even then, the taxation was a gray area. Okay, and that's a positive. The problem which comes is that what happens when certain covenants are broken. Okay, you want a quick remedy. You want enforceability of this thing. You want that if you have a drag along clause, those are taken care of. If there are certain covenants are broken, whether it is say from a debt perspective or an equity perspective, how quickly are the remedial portions taken? The fund has a finite life. So if I'm looking at an investment horizon of 2 to 5, 6 years, within those period, I want a resolution. And we know what is the pendency in Indian courts. We know how things can get dragged on. So none of us wants to do so. And then the other piece which I'm been also hearing is that quite a few startups today are catering or having business models which are focusing on say a European or US market or for other locations. The next round of funding or the next growth phase for them comes outside the country. They may look at Singapore or a NASDAQ listing at some point of time. So the holding company moves out of the country. What happens to taxation there? What happens to peace? So if I look at it globally, for money coming into India, and when I ran an FI into India, it was that if you did equity investments, you came in via Mauritius. It was a tried, tested route. Later on, Singapore became venue. If you were trying to do debt, you did it through Cyprus. Okay, and these were the various. So you had other locations, but these are tried and tested. So you had legacies. You could cite previous verdicts. You could cite. So everyone was fairly comfortable in terms. Predictability was there. See, the problem with any investment or for any investor or for any strategic partner is predictability. If you know how what will be an outcome to an extent, you are happy to go around that route. Otherwise, there's this thing. So there are changes like everyone's been mentioning that your taxability, the double taxation treaties with multiple countries coming in, trying to equalize. So if you look at the initiative on Gift City, which has come up, you're trying to say that why should domestic fund managers pay us charge as service tax, whereas international fund managers don't need it. So that's a 20% or 18% hit is a fairly large part that can increase alpha for the investors. Now, these are things somewhere you have to come to a level playing field. And if you look at why is today arbitration, you have Singapore as one of the most preferred seats, there's a finite timeline. So if there's any dispute, you come out of it, irrespective of the outcome. There is a timeline within which it will get settled. And hence, because of knowing the timeline, most of the things don't go in there. You sit amicably and sort it out.
Yeah, I agree, Ashwini. So you raised 3-4 questions. One, you said predictability. The second, you said timeline. Then you said some of the clauses under the agreement like drag. Pooja?
Yeah.
I have a slightly different view, Ashwini, but let Pooja.
So I would not entirely refute to what Ashwini says, because the moment we utter the word startup, we have to understand startups do not necessarily mean million-dollar companies or startups which have VCs and other big investors with a lot of money. Those are not startups. I mean, those are two startups, but startups are also companies who started out of a 1 BHK. I mean, there are founders sitting there, living there, sleeping there. That is where a startup is actually, that's where the birth of startup actually happens. Now, if you look at those size of startups and they have raised an amount of 20 lakhs, 30 lakhs with a 70-pager SHA shareholding agreement, which a lawyer gives them, enforcing them, every SHA will have an arbitration clause. Going to actually executing this process is not viable from a time perspective also, and also from a cost perspective for startups. Bigger startups with tier A law firms backing them, it's comparatively still an option, but for smaller startups, it's absolutely out of question. And then the question remains, what is the use of having a 70-pager shareholding agreement if it cannot be enforced, if the startup cannot afford to enforce it? How are we protecting the investor in entirety? So that question for extremely early stage startups still remains. For bigger size startups, they can always go for arbitration. There are these options available. And I agree when Ashwini says that this is a fact, startups which can afford are actually choosing Singapore and other jurisdictions because of the time. I mean, these are practical issues. I mean, we need to get out of the lawyer sentiment here, and there's no reason to be. I mean, I don't feel we need to get offended. That's a fact. I've been in litigation. I've seen the kind of time and money it takes, and it's actually startups cannot afford it, and it's actually creating a hassle. So we as lawyers also, when we are working on the restructuring of startups, and at the same time we are working with investors, often we have to come with a midway of, if in case a dispute arises, how are we supposed to settle the dispute without necessarily choosing arbitration or going to the court? So I think that creativity needs to be there. We often have to come up with solutions when we are working with startups, and that's the only way, because we really do not want to compromise on the economy startups is generating, with the business startup is generating. We don't want them to stuck in the legal and compliance hassles. So yes, so to a very large extent, this is true. The lawyer in me is disappointed when I hear things like this, but I have to be practical at some point of time, because I'm really working with smaller startups. You actually can feel the pain that they go through. I mean, I won't be wrong in saying, with the kind of startups I have seen now grown into very, very big entities, but the entrepreneurial fire in them is so strong. I've seen them skipping meals just to run. So that's the sentiment. I feel startup is a sentiment. I mean, we need to respect that. I mean, I'm sorry if I'm going a little out of the question here, but I feel we need to reduce as much as problems as we can for these startups, because smaller startups are actually facing the brunt of this.
Yeah, Ashwini.
Just to add to it, I think the challenge which all of us face as part of the ecosystem is that how do we create the trust part when you're lending. So if you look at it, how has historically this happened? Why do you start with friends and family? Because they know you, they trust you, right? You had communities which lend within the community to people saying that, okay, he or she is from the community or from my region or from my particular business part, or I have known XYZ and hence, I'm taking a bet on. That's how earlier part. And there was no what is called likhapati, right? No write-up or this thing. You went on a peer. Today, as you move to a little more formal world, and for people who are regulated such as us, unfortunately have to look at. So how do you do a light touch, which which takes care of things as well as ensures that the poor startup, like Pooja mentioned, it could be a 1 person, 2 persons operating. It's not just burdened looking at the sheer amount of compliances and stuff and think that, oh God, when do I do my business and when do I look at ensuring that I'm compliant with all of this?
I fully agree with Ashwini, you and Pooja, whatever you said. I think more and more that we see but the couple of things that I would want to add, Ashwini, and we have been in this profession for last almost 20 years now, and I've seen that journey. earlier, when we used to get on a call with any of the offshore fund or their lawyers, the first statement they would make is, if at all you end up in a litigation in India, your funds wound up and you are seeing a 10 years horizon. I would say we have come a great way on that. I think all the service providers, whether it's lawyers or investors, that there is some sort of an element of, as you said, trust, and that opportunity that we need to tie in and find that middle path. I think the best advice you can go is not to do litigation and find a way to solve the problem. But in some situations where it's inevitable, I would say with SISC, as you mentioned, with their seat in Delhi, with alternate remedy available, courts now looking at an arbitration award very minutely, very difficult to challenge that. I think that 10 to 15 years have maybe cut short to 2 to 5 years. I mean, it's not enough, but I think it's systems moving towards their with own set of challenges. But the trust that we had 10, 15 years back in that system and the jurisprudence, and we have now, I think at least there is a good amount of progress. Hope that continues. But that leaves me with one other. Sorry.
I'm so sorry, Darshan. I would just
Yeah.
like to slightly add, you're correct. The time span has definitely reduced from 10 years to 2 3 years. But we have to look at this way. The founder has to make a choice between 2 3 years of running his business and 2 3 years of spending money on litigation or arbitration, whatever it is. So that choice at times gets very difficult. Also, when an investor has invested money, it cannot be only the founder's decision कि हमको litigation करना है कि arbitration करना है कैसे settle करना है. The investor also has a major role to play in the decision as to how the money is to be spent and what kind of money. In the first place, we all know the kind of bills corporate lawyers and everybody, I mean lawyers and arbitrators have. It's not a cheap, it's not an inexpensive process.
I fully agree. That's why I say it's a path that has to be chosen. It equally applies to both promoters and investors. Fund may be at the fag end and they need a quick remedy. But having said that, I think it leaves me to one other important question. We keep on hearing, every day we open a newspaper, we will find a unicorn or a new investment coming in. There may be, if the numbers are right, last year itself, there might have been almost total 50,000 some odd startups. Now, many of them may fail. Many of them may not take it to that next level. What happens to them? Is there an easy way you have found for your investment to come out, for the startup to close and move on? At least my experience has been that as lawyers, it's been extremely difficult both on the law and on the process. And investors may have one investment written off, but for the other side, the guy takes years to move on from that legacy and come out of that. Would like to hear from you. Pooja, let's start from you since you've been on the startup side so close.
I'm actually very emotionally involved in this. My answers could be a little away. So basically, I've had a startup and I've miserably failed in India again. The reason I'm highlighting it here, probably, I mean, investors, the favorite word that they have is market size. Okay, so when you're dealing with them, the word that you hear often is market size. So I have failed in India when I had my own startup. I have seen a lot of entrepreneurs, I wouldn't use the word failing, but not being really unsuccessful at what they, not being really successful at what they launched and what they thought was going to be very successful in the market that they were launching. I feel one reason why they get affected, and slowly as you move on your entrepreneurial journey, you realize there's no reason to be, people do get emotionally attached with their startups to an extent that they get obsessed with it. And that is where even when investors and others try to highlight that this product might not work, they're not ready to accept it in the early stage until it fails. So my experience has been whenever I'm working with startups and I feel that this particular idea is going to sink, it's not viable, I do give them the hints, but they're not prepared to take it. So I think my first observation with entrepreneurs is that they need to have a very impartial, unbiased opinion with their startup and not get obsessed with it, to not take negative remarks. They usually do not appreciate investors giving a very critical opinion. So I think if entrepreneurs try to take those negative remarks as positives, that might help them, that might reduce the failure, unsuccess rate that we have today. Having said that, with most of the founders that I've worked, I've seen that they never stop. an entrepreneur who has failed at one startup will come up with, he'll do a job for some time and then he'll come back again, he'll bounce back, he'll start with something else, he'll ensure that he'll not repeat the mistakes. I mean, I love going to Starbucks on a weekend only to see entrepreneurs working there Saturday, Sunday. I mean, others, corporate people are waiting for the weekend and entrepreneurs are working on a weekend. That's the best part. You'll never see them, they'll be demotivated, but you'll never see them getting demoralized or stopping what
I agree. I think Pooja, what I was asking is, and is that do we have that legal system like in US and other places where you allow them to move on? And see, we had the fast track scheme, which is now not available. We have the winding up route, which is a very, very long-term process. Investors, we find that as simple as Ashwini, we were talking to someone and they're saying, I have written off the investment, but the share certificates are still there. I mean, how do I clean it up from my asset? So things like this. So the question was, is this enough, and what is that is expected on how to take this, as a...
I feel winding up is a very big problem. I'm so sorry, I did not get your question right in that case. I feel winding up of companies is the biggest problem that you have. So if a particular startup has sunk, it's not doing well, you have investors there, if the cap table is huge, winding up the company becomes a problem. And until you've not wound it up, starting a new company again is, I mean, you can obviously start, there's no constraint, but then setting up a new company, if the investors know about it, it's going to create a problem. You're not going to...
So we don't have that ecosystem currently, which is... Yeah, Ashwini, you were saying something.
Yeah, I was just adding on to what Pooja was mentioning. I'll break my answer into two aspects. The first one being the procedural part. So we have seen that, if you try and opening a company today has become honestly a very easy process, and one should thank the process, so you can get your PAN immediately, moment your thing comes and you get your, your GST, TAN, all of those things are fairly quick compared to what you had earlier, a month, or checking of name, blocking of name, all of those things are fairly. The problem comes is that the virtue of being a startup is that you would see failures. Okay, when you see failures, then the closure piece has to be quick. See, the unfortunate problem in our whatever taxation and otherwise legal system has been that we treat the promoter as a thief, as a cheat, has malified intentions, if I were to use the proper language. Okay, so what happens is that you have statutory pieces which should be left out, which are there, the tax part from the company perspective, and also from the investor, because the investor has to write off. Now he can write off only when the company's piece is sorted out. So that's some part where you have to come to a defined timeline saying that, look, if this venture is not working, we are all getting out of it. The promoter starts a new life, moves on. The investors move on with their investment write-off or whatsoever salvage value comes out of it. If you can have an IBC which defines for larger corporates what's a timeline, why can't you have it for startups? And startups, actually, you have lesser history. So by definition, you will not have more than 3-4 years, even 1 year, 2 years of history to take a final call. And you have resolution professionals for IBC. Why can't you have something similar, which is light touch? Because again, there's not large money which is available, and this is something which has gone down. Generally, you don't have assets. So how do you go about it? So that's one part, procedure. We'll have to see how things, people are giving thoughts, but we are yet to see things being put in place. The second part is that Indians as a part, there has been a stigma associated with failure, whether it has been on a career part, and same has been in terms of businesses. That has to go. It is a learning, and if we learn from this is a very, very valuable learning for anyone, which they can get. I was meeting a Berkeley professor who used to work with one of the large startup companies before he went to US in New York. And he was saying the problem is if an entrepreneur fails and he is initially taken from friends and families, till he passes away, he's always reminded that, boss, I put money with you and it's gone down. Okay, but you do not take that the person was brave enough to try and live his dream. And there should not be a stigma around. If it is not a fraud case, if it has been a genuine effort by the investor, and I've seen very good startups fail during the COVID times because nobody predicted how long it will last or how quickly it will hit us. Okay, the disrupt. So somehow we have to be a little more forgiving in some parts, and somehow we need to have appropriate timelines. See, we don't have a bankruptcy part, right? Because most of the places today, if you were to look at banks, if you look at any of the debt covenants, there are a lot of personal guarantees which come out of it. Okay, now how do I do a closure on it and move on? It's not defined yet.
I fully agree. Yeah. And I think that's what Pooja was also mentioning. Madhura, do we have time for questions and any closing remarks from the panelists?
Yes, yes, certainly. So if there are any questions from the participants, you may please just unmute yourself and ask the question or put it in the chat box. Maybe we'll wait for next 30 seconds for anyone to speak up.
Yeah, so I can just give my couple of bits, Darshan, on the last question. And so I would like to just make some factual statements here. I think, first of all, before a founder starts a company, it is an advice that don't start, the first question that they say, okay, I want to set up a company. Okay. And can you help me set it up? So, I think it's important that they take some time in coming up to a prototype or, develop the idea, because starting a company is not starting a startup, first of all. So that also they need to be very conscious about. Second thing is that I would like to mention, to Ashwini's point, with the introduction of NCLT, we are seeing a very, very fast track progress on the liquidation of certain companies. We've seen certain issues where there are foreign investors involved, where the whole dealing with RBI and the AD bank gets a little difficult because they have certain protocols and approvals that they need. But there is certainly a very positive development that we have seen as compared to the earlier regime. I think the third thing is that the whole genesis of startup, I think, whether an investor is asking a question around this litigation or a founder is asking a question, the clear message there is to start with, it was a very high risk, high reward game. All right. And every litigation or an issue that you would like to discuss, keep that perspective in mind, and then you take your corrective course of action. Darshan was asking about, what does a founder do? I think a founder can do a lot of things. First of all, the founder needs to send very, very early warning signals to all the investors, which I think is their responsibility. Having done that, the investor do have ability to pivot the business models, sell some of the businesses, make the company available to other, sort of startups who are doing some business. You can look at amalgamations, and we have seen, we have seen some funny situations also where people were interested in the losses of some of these startups, and there were structures being done to sort of how do you utilize them. So there are certain options. I think it also depends on how quick a founder is willing to open up his books and his Pandora's box, and come and discuss with the investors and advisors upfront. I think these are my 2 bits on what you guys have been discussing.
Very valid points. That I think all of them are practically very sound. We see many of the startups coming up from their we have seen from studios and from garages, and also we have one question from a participant saying, is it necessary for, I'll just read it out, is it necessary for student-led startup to be absolutely novel? Can't we provide promising services than previously running startup? I'm also eager to know about some legal tech startup experience. So I split it up into 2. Is it necessary for student-led startups to be absolutely novel? Can't they be promising service than previously running startup? Ashwini?
See, I think what everyone should realize is that every startup is not born to become a unicorn. Okay, if a startup, why have you started something? You've started because you feel there's a demand, and you can service a demand properly. Okay, so it could be, so let's look at a bakery a cornerstone bakery is also a business. That's also a startup when a new bakery opens up. Okay. Does it have to necessarily become an international bakery chain or an pan-India bakery chain, pan-state bakery? No, not necessary. Okay. So going to Ishani's part, if a student is providing services which are professional, which are good, which has got a buyer, that's a normal business. Absolutely no issue for anything to be novel. If you're doing it better and at the right business model, you don't need to be novel. You know, sometimes some of the biggest successes in the world have come from copycat ideas who have executed it better than somebody else.
I agree. The next question was, do we eager to know about some of the legal tech startups experience? Pooja, you or Darshan have any feedback on that? The question says, I'm eager to know about some legal tech startups experience.
Yeah, I mean, I've worked with quite a few legal tech startups, a lot of them working in the contract management industry, online dispute resolutions, where former judges of high courts are also on the advisory position, which is a great thing. I mean, but what disappoints me is not all these startups are started by lawyers. So the startups are actually started by non-lawyers. I really do not know how far they will go, but online management, litigation management, these are services that there's a considerable market size, but if it does not have it just has a technical backing and no legal understanding, if the founder does not understand the ground level problems, I really do not know how far they will go. But then you have something called Law Seco right now. It's not really a legal tech startup, but I think they're breaking barriers with everybody doing courses on Law Seco. That does not necessarily involve tech, but still doing a brilliant job. So Ramanuj, who's also a National Law School graduate, is doing a wonderful job there. So I think, yes, so we do have the scope, but we really have to be innovative with what are we exactly going to do, how are we going to do it, and how are we going to execute it. And as they say, idea is having an idea is not, it's not nothing great about having an idea. Execution is what really matters. So there's a lot of scope, but we still need to work on it.
Okay, perfect. Madhura, if you have exhausted or overshot our time, sorry for that. If no other questions, can we, I would like to thank Aaron, my friend, and also the chair for the ILA, Madhura. And thank you all the panelists, Ashwini, Darshan, Pooja. Absolutely a pleasure. Wish you all a very Merry Christmas and a very Happy New Year. Stay safe. Madhura, anything else?
That's it, Darshan. Thank you so much to all our speakers and of course our wonderful moderator, Darshan, for such an insightful and interesting session today on startups. So this event was brought to us by ILA Mumbai chapter, and we look forward to host many more such events online and in physical formats in 2022. If there are any participants from Mumbai, please do get in touch with us exclusively after this session on my mail ID, which I'll just put on the chat box. So we can reach out to you separately for all our in-person events. And thank you so much once again. Have a great weekend and a wonderful 2022. Thank you.
Thank you so much.
Pleasure. Thank you.
Have a good day.